Hello students. Good morning students. Today I'll be covering chapter capital budgeting. Capital budgeting. This chapter is very important from exam point of view. In this chapter, you will be learning methods of evaluating capital projects. Now, in case of big companies, they invest in projects, and big projects may be involving huge amounts, that is in crores. Okay, so if any investment goes in the wrong project, then there will be a huge loss. Company may have to wind up its business. So capital projects are very important and needs proper evaluation. Okay, so in this chapter you will be learning how to evaluate capital projects. Okay, so there are basically two types of methods. First type is traditional methods and second is modern methods. Okay, in exams you will be asked both of them. Okay, there will be two questions in your paper for from this chapter. Okay, one question may be asking only traditional method, and second question will be a full-fledged sum which will ask you to evaluate projects by traditional as well as modern methods. Okay, so I'll be teaching you these methods today. And now I have taken one small sum which will cover our traditional method. Okay, so I'll just read this question. Students, please watch this video in full screen mode, so everything will be visible properly. Okay, so I'll read the sum. Pawan Limited is considering two projects. Both require an initial cash investment of rupees 10 lakhs each and have a life of 5 years with nil scrap value. Okay, so scrap value means residual value. At the end of life of the asset, it will not fetch anything. Value will be 0. Estimated net profit before tax of machine A and machine B is given to you. Okay, for machine A, it is constant 4 lakhs every year we are receiving as profit. In case of machine B, in first year it will give a profit of 6 lakhs. Okay, and this profit is before tax. Okay, then 3 lakhs second year, 3 lakhs again third year, then 4 and 5th year it is giving us profit of 5 lakhs. Okay, so by using this information I'll teach you traditional methods. I have listed down two methods. One is payback period and second is ARR method. Okay students, so before we start with these methods, one more thing I'll have to teach you, that is calculating cash inflows. Okay, I'll make a format here for calculation of cash inflows. I'll make a format. We'll need one particular amount. I'll make this for project A, machine A. I'll make this for machine A. Okay. So start with the amount which is given to you. Now the profit given to you is before tax. Okay, so I'll start with net profit before tax. Okay, so from net profit before tax, first we have to deduct tax. So I'll write less tax. Okay, we get net profit after tax. Okay, so to get cash inflow in net profit after tax, we have to add back depreciation. So I'll write add depreciation. Okay, we'll get cash inflow. Okay, now see, in case of machine A, we have uniform cash profits. Okay, so even a common calculation is fine. Okay, in case of machine B, all the profit figures are different, so we'll be making 5 income statements. So we'll have 5 columns for that. I'll show you that also. Okay. Okay. So whenever a question is given, first make this statement, that is calculation of cash inflow. This is the first step you have to follow. Okay. First find out cash inflows. How to do it? Begin with the profit what is given to you. Okay. In this question, you are told that the profit given to you are net profit before tax values. Okay. For A as well as B. So I'm calculating for machine A now. Okay. So we'll begin with net profit before tax. Okay. Since profit is constant in all the 5 years, I need not do it 5 times. I'll just do it once. Okay. So I'll start with 4 lakh. Clear? Okay. Then look for the tax rate given. Tax rate given is 30%. Always calculate tax on net profit before tax. Okay. So on 4 lakh, do the calculation 4 lakh into 30%. I'm getting 1,20,000 as tax. Okay. So now I will deduct tax from net profit before tax. I'll get net profit after tax figure. Okay. So 4 lakh minus 1,20,000. So net profit after tax value is 2,80,000. Clear, students? Now, this net profit after tax, can we say this is the profit we have earned? Yes, this is the profit. But can we say this is my cash inflow? No, right? There is a small difference between net profit after tax and cash inflow. Although whatever profit we earn, we receive as a cash inflow, isn't it? But there are some expenses which does not result in cash outflow. So in a way, they are our savings of cash. So we add them as a savings of cash outflow. So they become cash inflow for us, like depreciation. Although depreciation is taken as expense in your P&L account, but if depreciation is not paid to anyone. Clear? So that amount of expense is not paid to anyone. So that should add to your profit to get cash inflow. Okay. So I'll show you how to calculate depreciation. Okay. Very simple formula for calculating depreciation. Formula is cost of machine minus scrap value of that machine upon estimated life, upon estimated life of machine. Okay, students, very simple formula to calculate depreciation. So I put in the values. Cost of machine is, that is investment. So it is given in second line, 10 lakh rupees. Okay, so 10 lakh minus scrap value is 0. They said it is nil after 5 years. Okay, and life of project is 5 years. Machine is 5 years. Okay, so your answer will be 10 lakhs divided by 5. So 2 lakhs per annum is your depreciation. Students, is this clear? How to calculate depreciation? Very simple. Cost of that asset or project cost or machine cost divided by life of the machine. So 10 lakhs divided by 5 is 2 lakhs depreciation per annum. So I'll write it here. 2 lakhs is your depreciation. Clear? So we have to add it to profit after tax figure to get the amount of cash inflow. Okay. So our cash inflow is 4,80,000. I hope this is clear. Okay. So step 1 is to calculate cash inflows for different machines. If 2 machines are given or 3 are given, first find cash inflow for that machine. Okay. Now I'll explain you these methods and I'll solve them one by one. Okay. See, as I told you, in capital budgeting we have 2 methods. One is traditional, second is modern. These are broad categories. Okay. Under traditional we have payback period method and ARR. Okay. One more is there. I'll just add that here so that you will learn all the 3. Second is post payback profitability method. Okay, so these 3 methods are there. Okay, first one is payback period. This is very simple method, payback period method. This method says that you choose that machine which will pay back your capital in lesser time. Okay, which will pay back your capital invested in lesser time. Okay. Now again here we have 2 types of inflows. One is uniform cash inflow, which is for machine A, and uneven cash inflow. See, in machine B, profits are different every year. So every year cash inflows will be different. But for machine A, uniform cash inflows are there. So we will use this formula. Initial investment upon annual cash inflows for machine A. Okay. So I will calculate here itself. So I'll write here machine A. And copy the formula besides or below our calculations, so you don't get confused with all the formulas. Here it is now. Okay. So first we are calculating payback period. Okay. And under payback period we'll be using uniform cash inflows. In the cash inflows for machine A are constant, uniform. Okay, so use this formula, very simple formula. Initial investment, that is how much you have put in to buy that asset, divided by annual cash inflow, how much cash is generated by that project. Okay, very simple formula. So initial investment is 10 lakhs, right? And 10 lakhs divided by annual cash inflow for machine A is 4,80,000, right? We just calculated 4,80,000. Okay, so divide this, we'll get payback period for machine A. So 10 lakhs divided by 480. It's 2.08 years. Okay, so in almost 2 years you are recovering your capital. Okay. So this was payback period for machine A, 2 years. We will calculate payback period for B as well. Okay. Then the machine which has least payback period will be selected. If we are following payback period method, okay, likewise you have to write a statement that as per payback period we should choose machine A. It is a lesser or shorter payback period. Okay, I'll just revise once again. In question, you may be asked to calculate payback period or ARR. Okay, I'm showing you all three methods in the same sum. Okay, all traditional methods I'm covering in this sum. Okay, so there are three methods I have mentioned. First, payback period. Second, post payback profitability, and third, ARR. Okay, these three methods I'm going to show you from this sum. Okay, so first one is done. Very simple formula. Okay, for payback period, initial investment upon annual cash inflow. Initial investment will be given in the sum, in the paragraph form. Okay, and annual cash inflows we found out by making that table. You can see here, and just make it tabular format. Okay, so we made this a statement in which we found out cash inflow. Okay. So whatever stage of profit is given to you, you begin with that. In this sum, it was given net profit before tax. So we started with net profit before tax, then deduct tax, we get net profit after tax. Okay. Then add back depreciation. This step is very important. Add back depreciation. Okay, we get cash inflows. How to calculate depreciation? Very simple. Use this formula. Cost of asset minus scrap upon estimated life. Okay, so cost of asset was 10 lakh, scrap was 0, estimated life is 5 years. So depreciation per annum is 2 lakh. Okay. So in the statement we added this to get cash inflow, which is 4,80,000. Okay, so in formula we use this cash inflow. Okay, so 10 lakh divided by 4,80,000, we got 2.08 years as payback period. It means in 2.08 years, whatever amount we had invested is recovered. Clear, students? Okay. Now for the same machine, I will show you second method, post payback profitability method. This is also very simple. I'll show you. Formula for this is total cash inflows minus initial investment. Okay. Now how to get total cash inflow? For 1 year, cash inflow is 4,80,000. Okay, so for 5 years, it will be how much? So it will be 4,80,000 into 5. Clear? This will be total cash inflow minus initial investment is 10 lakh. Okay, so I'll write the value now. 4,80,000 into 5 will be 24 lakh minus 10 lakh. My answer is 14 lakh. Clear? So even second method is very simple. What you have to do, you have to calculate total cash inflow in the entire period of 5 years. So every year it is 4,80,000 into 5. We got 24 lakh as our total cash inflow for this machine A. And what is the initial investment? 10 lakh. So net amount 14 lakh is your vehicle. Post payback profitability. It means after paying back your capital, how much is the profit? So we have inflow of 24 lakhs, and if I repay 10 lakhs as capital, still my profit is 14 lakhs. Clear? Very simple formula, easy to remember. Okay, now third and last formula. It is ARR. Okay, from here, full form of ARR is accounting rate of return or average rate of return, or even some call it annual rate of return. Anything is okay. Formula for that is average net profit after tax upon average investment into 100. Even you can take original investment, that's fine. Okay, into 100. So what is the average net profit after tax? You have to go to our first table. Look here. While calculating cash inflows, we had calculated net profit after tax. Remember, 4 lakhs minus tax, we got net profit after tax. So every year it is same for machine A. So your average PAT is 2,80,000. Clear, students? So average profit after tax is 2,80,000. Okay. Then what is the average investment? I'll write down the formula for average investment. Initial investment minus scrap the formula includes plus working capital, but it will not be there at your level, plus scrap. Okay, and here it is divided by life. Okay, minute. Okay, so formula is, otherwise one more alternative formula is there. I'll give you that one. That will be very but even this will work. So let us calculate by this method. Okay, so initial investment is 10 lakhs. Minus scrap is 0. Plus working capital is also 0. And is again 0. And 5. So we'll get annualized investment. Instead, you can do the other formula also. Other formula is very simple. I suggest I use that one only. Wait, I'll give you the other formula. Since that will be very simple for you. The other formula is opening investment plus closing investment divided by 2. This is better for you, I guess, at your level. So opening investment is 10 lakhs and closing scrap value is 0. Okay, divide by 2. I suggest you use this one only. Okay. So your average investment will be 5 lakhs. Okay, you use this one. It is better for you. Upon 5 lakhs into 100. That's it. Okay, use this one only. Okay, so now I'll calculate the percentage. So 2,80,000 divided by 5 lakhs into 100. So 56%. Okay. So these were 3 traditional methods which I showed you. Okay. In exam, one sum for 10 marks will be like this. Okay. In which will be asked to calculate payback period and ARR. Okay. Now this was only for machine A. Same way we have to do it for machine B. So in this sum you can see in the question, they have asked you to calculate only ARR. Okay, payback period, post payback profitability is not asked. Okay, but it will give you 10 marks. Okay. Now I'll do it for machine B as well now. Okay, I'll do it for machine B. Now, as I told you, for machine B, we have to first calculate cash inflows, but therein every other profit figure is different. So we have to make 5 columns for calculating 5 different cash flow figures for 5 years. Okay, so I'll just change the format a little bit. I'll draw the format now. First column will be net profit before tax. Okay, from that we subtract tax. Okay, we get net profit after tax. Then we add depreciation. We get cash inflow. Okay, and we need to for 5 years. So 1, 2, 3, 4, 5. Okay, first I will put in the figures of net profit before tax. 6 lakhs for first year, then 3 lakhs, again 3 lakhs, and then 5 lakhs each for 4th and 5th year. Okay, students, just a moment. Students, you can watch this video again and again using the same link. Okay, so if you have any doubts, you can just watch it again. Okay. Tax calculation, it is 30% of net profit before tax. So it will be on 6 lakhs into 30%. Okay. Always calculate tax on net profit before tax figure. I'll copy this for all the 5 years. So I get tax figure. In second year, tax has reduced. Since profit was half, even your tax was half. Okay. So next column is net profit after tax. How you will get that? Net profit before tax minus tax will give you net profit after tax. So 6 lakhs minus 1 lakh 80,000, you get 4 lakh 20,000. I'll copy the same formula for remaining 4 years. Clear? Now depreciation calculation will be same because cost of both machines is 10 lakhs and life of both machines is 5 years. So depreciation will be same. Okay, so we need not do it again. So I'll write 2 lakh for all the 5 years. Understood now? Why? Because cost of machine is same and life is also same, so depreciation will be also same. Now how I'll get cash inflow? Add net profit after tax plus depreciation will give me cash inflow. So I'll copy the same formula for remaining 4 years. That's it. Okay, students. Now, whenever cash inflows are uneven, we need to have one more column. Okay, apart from this cash inflow, we need cumulative cash inflow column. Okay, so I will draw it. I'll make one more column. Cumulative cash inflow. Okay. In cumulative, we just have to go on adding. You must have learned this in statistics. Okay, so for first year, my total cash inflow is how much? 6,20,000 only. Okay. Okay. Now in second year, I'll add 620 plus 4,10,000. Okay, just go on adding. Understood? So previous year total plus current year's cash. 10,30,000. Now how you get for third year? 10,30,000 plus 410. Understood now? So total till previous year plus current year's cash. Okay. Now for fourth year, first take total of third year plus fourth year's figure. How to get fifth year's cash inflow? Cumulative total till fourth year plus current year's cash. Clear? So 25,40,000. If you add all cash inflows, you'll get the same figure. Yes, 25,40,000. Clear? And just some of the values. Yeah, that's it. Clear, students? Now, first, again, we'll calculate those three things: payback period, post payback profitability, and ARR. Okay. So in payback period, in this machine we have uneven cash inflows. So there is a different formula for that. You can see on the right hand side, I have written it uneven cash inflows and just copy formula from there and write it here. Okay. So first formula is payback period so formula is complete years. Now what is complete years? I'll tell you how to get this number complete years. Now what is our initial investment, students? 10 lakh. So in cumulative column, just mark that year, okay, which is closest to 10 lakh. But it should not surplus 10 lakh figures. Okay, it should be closest to 10 lakh, but it should not surpass that 10 lakh figure. It should be closer enough to say that we are close to 10 lakh, but it should not go beyond 10 lakh. So in first year, what is your cumulative figure? 6,20,000. Clear? What is in second year? It is 10,30,000. So it is going beyond 10 lakh. So we have to take first year only as complete year. Okay, so I'll write completed is only 1. Before reaching 10 lakh, we have completed only 1 year. Okay, so complete year will be 1 plus shortfall in initial investment. Okay, so in first year we have collected or rather accumulated 6,20,000 as cash inflow. Clear? And our target is 10 lakh. So how much shortfall is there? So 10 lakhs minus 6,20,000 is our shortfall, isn't it? I'll write it. 10 lakhs minus 6,20,000. Okay, that is a shortfall. Clear? Upon next year's cash inflow. So second year's cash inflow, I'll just make it bold. Next year cash inflow is 4,10,000. Okay. All right. 4,10,000. That's it. Okay, this one will remain as it is. 1 plus. Now solve this second part. 10 lakhs minus 6,20,000. 10 lakhs minus 6,20,000 divided by 4,10,000. Okay, if we solve this, we'll get. I'll do it in next line. Again, I'll carry forward it. And I'll solve that. 3,80,000 divided by 4,10,000. So I'm getting 0.92. So my answer is 1.92. I'll just round it up to 3 years. This is my answer for first method, payback period. Okay. Now as per for same method for machine A, it was how much? 2.08 years, right? Payback period for machine A was how much? 2.08 years. And for machine B, the payback period is 1.93 years. So as per this method, which machine shall we select? We have to select machine B, and the payback period is shorter in case of machine B. Machine B is paying you your capital back in only 1.93 years, whereas machine A is taking more than 2 years, 2.08 years. You have to write this statement after comparing payback period of these two machines. Okay. So I'll write statement as per payback period method. Machine B will be selected. Okay. Same way we'll be doing post payback profitability. Okay, and ARR. And accordingly we'll be writing the statement. Okay. So let us go for the second method and just copy the formula here below machine B. Okay, so post payback profitability method formula is total cash inflow minus initial investment. So what is our total cash inflow, students? 25,40,000, isn't it? 25,40,000 minus initial investment is 10 lakh. Okay, so answer will be 15,40,000. Okay, in case of machine A, what was the answer? 14 lakh. Means after paying back profit, there was a residual or rather profit of 14 lakhs only, whereas in machine B it is 15,40,000. So again, as per this method, we will select machine B. So I'll write as per post payback profitability method, machine B will be selected. Okay. Since it gives higher post payback profit. Clear, students? Now the third method, ARR. Okay. Just copy the formula here, this side. Okay. So again, we need average profit after tax upon average investment. Average investment will be same. We had calculated the 5 lakhs. It will be same. So I'll just copy this as it is for this machine also. Now we need average profit after tax. So if you go to our statement, just a minute, and make it a proper format. So can you see net profit after tax column? Okay. So if we add that column, we'll get total profit made during 5 years. But we want average. So this 15,40,000 is for 5 years. For 1 year, how will get? If you divide it by 5, we'll get 1 year's average profit. Clear? So just remember this figure, 15,40,000. Okay. So my average profit is average profit after tax is equal to total profit after tax divided by 5 years. Okay. So my total profit was 15,40,000 divided by 5 years. Okay, so answer is 15,40,000 divided by 5. So 3,08,000. So I use these values. 3,08,000 is my PAT. Average investment is 5 lakhs into 100. So if I solve this, I'll get answer as PAT 308, not PAT, upon 5 lakhs into 100. 61.6%. Okay. So even as per this method, we should select machine B. Okay. So I'll write that statement. As per ARR method, company should select machine B as its ARR is higher. Okay, that's it, students. I'll just reduce the size so that you can take a screenshot if you want. Shift everything little up. Okay, sure, you can take a screenshot if you want. I hope you have understood. Whenever you need any clarification, you can just what you can do is you can click the same links, run the video again, and wherever you have doubt, you listen to it twice, as many times as you need, and get the sum solved. Okay. Okay, that's it. So today I have taught you traditional methods. Okay, there will be a 10 mark sum. Okay, based on this method, 3 methods. Okay, and one 20 mark sum will be there, which will cover traditional as well as modern techniques. Okay, in next lecture I will cover those modern techniques also. Okay, thank you students for watching. Bye, see you, take care. If you have any doubts, you can message me. You have my number in the group. Okay, do send me a message. Thank you. Bye.